Overconfidence will blow your account faster than fear ever will. And if you've been in the market long enough, you know this truth sits deeper than any technical strategy you've ever learned. Overconfidence is the silent killer of traders, because unlike fear, it doesn't show up with warning signs. Fear feels uncomfortable. Overconfidence feels good. And that is exactly why it's dangerous. Fear makes you cautious. Overconfidence makes you reckless. Fear might delay a winning trade. Overconfidence will guarantee a losing one. Fear makes you check the charts twice. Overconfidence makes you skip the rules you spent months building. And what so many traders don't understand is that the market punishes recklessness far more brutally than it punishes hesitation. Think about your worst losses. Think about the times your account took a beating you didn't expect. Most of those losses didn't come from fear, they came from moments when you felt unstoppable. When a winning streak made you feel like you had the market figured out. When you took a trade not because it aligned with your strategy, but because you felt confident, powerful, in control. Overconfidence gives you that temporary high, the feeling that you're smarter than the market, until reality comes back to humble you. Overconfidence makes you forget that trading is not about winning. Trading is about surviving. It's about protecting your capital long enough for your edge to show up. Every strategy in the world only works with consistency, and consistency only survives when you control your emotions. Overconfidence destroys that control. It tells you your rules don't matter. It tells you your stop loss is unnecessary. It tells you that this time will be different simply because you feel good. But the market doesn't care how you feel. The market doesn't reward confidence. It rewards discipline, patience, and humility. Overconfidence starts small. It begins with a win. Then another. Then a few more. Suddenly you start believing the outcome is a result of your intelligence and not the randomness of the market. You start increasing your lot size. You start holding trades longer than your plan says. You take trades without confirmation because you think you can see what the market is about to do. This is how traders dig their own graves without even realizing it. One of the biggest lies overconfidence tells you is that you can predict the market. No trader can predict anything with certainty. You can only react. You can only manage risk. But when you're overconfident, you don't think about reacting. You think about predicting. You think your analysis is perfect. You think the trend cannot reverse. You think this trade cannot go against you. And that's when the market chooses to turn. That's when the losses begin. That's when you start denying reality because your ego doesn't want to be wrong. Overconfidence turns small losses into big losses. When you're afraid, you close a trade quickly. But when you're overconfident, you hold it, hoping the market will move back in your favor. You convince yourself that the drawdown is temporary. You tell yourself you just need a little patience. You even add more positions to prove a point. But the market isn't listening. By the time you accept the loss, the damage is already done. Overconfidence is also the reason traders blow accounts during news events. They think just because they caught one major move in the past, they can catch the next one. They ignore the volatility. They ignore the spread. They ignore the unpredictability. They jump in because they're chasing the thrill and the profit. And within seconds, they watch their account liquidate. Not because the market was unfair, but because their ego was too loud. Fear protects your account. Overconfidence destroys it. When you're afraid, you check your lot size, you check your stop loss. You wait for confirmations, you measure your risk, you take your time. But when you're overconfident, you skip all of that. Fear slows you down. Overconfidence speeds you straight into disaster. Many traders think fear is the enemy. But fear is a natural part of trading. Fear makes you respect the market. Fear forces you to stay sharp. Fear keeps you humble. Controlled fear is healthy. It keeps you disciplined. It keeps you alert. It reminds you that anything can happen. But overconfidence blinds you. It convinces you that you're smarter than the charts, smarter than the fundamentals, smarter than millions of traders across the world. That mindset is dangerous. One of the ways overconfidence destroys traders is through revenge trading. When a trader is confident in their abilities and then suddenly they take a loss, the ego can't handle it. Instead of treating the loss as part of the game, the trader feels the need to win it back immediately. They want to prove to themselves that they're still in control. So they open another trade, find them, usually with zero analysis, then another, and another. And before they know it, they've turned a small loss into a massive one. Revenge trading comes from wounded pride, and wounded pride comes from overconfidence. Another common trap is trade stacking. When a trader feels confident, they don't stop at one position. They start stacking trades, increasing exposure far beyond what their account can handle. They tell themselves it's a safe trend. They tell themselves this move is guaranteed. They tell themselves they're just maximizing profit. But what they're really doing is gambling. No trader should ever treat the market like a casino, because even casinos have rules. Overconfident traders follow none. Overconfidence also makes you underestimate risk. It makes you forget that even the best setups fail. It makes you forget that your analysis can be wrong. It makes you forget that your stop loss exists to protect you. Traders who are overconfident shift their identity from risk managers to market predictors. But the truth is that you're not in the prediction business. You're in the risk management business. That's the difference between traders who survive and traders who blow accounts. The market will always humble you if you enter it with pride. It will always teach you that certainty is an illusion. It will always show you that emotion is expensive, and the most expensive emotion in trading is confidence without discipline. Real confidence comes from process. It comes from following your rules consistently. It comes from respecting your risk every single day. It comes from sticking to your strategy even when you feel like breaking it. That type of confidence is stable. It's quiet. It doesn't push you into unnecessary trades. It doesn't inflate your ego. Real confidence is measured. Overconfidence is uncontrolled. If you want to grow as a trader, you must constantly remind yourself that one good day doesn't make you a genius, and one bad day doesn't make you a failure. Success in trading is built over months and years, not days and weeks. Overconfidence makes you forget that. It makes you chase shortcuts. It makes you believe you can accelerate your growth by taking bigger risks. But growth is not speed. Growth is consistency. Great traders are not great because they win big. They are great because they avoid losing big. They know that blowing an account sets you back months. They know that capital preservation is more important than capital expansion. They know that the market will always be there tomorrow, next week, and next year, but your account may not be if you trade recklessly. To overcome overconfidence, you need self-awareness. You need to recognize when you're feeling too good. You need to check yourself when you start believing you can't lose. You need to step back when you start drifting away from your rules. You need to pause when your emotions begin to influence your decisions. That pause alone can save your account. Every time you catch yourself saying phrases like, "I'm sure," "it must go up," "it cannot reverse," or "this setup cannot fail," that is your warning sign. The market doesn't guarantee anything. No setup is perfect, no trend is permanent, no trader is invincible. If you want to survive long enough to succeed, you must treat the market with respect. You must treat every trade like a potential threat, not to make you fearful, but to make you disciplined. You must approach each position as if it's your first trade, not your 20th. Because the moment you start feeling too familiar, too relaxed, too confident, that's when mistakes happen. A trader who remains humble is a trader who stays profitable. A trader who allows ego to take control is a trader who eventually donates money back to the market. Experience doesn't protect you from overconfidence. In fact, the more experience you gain, the easier it becomes to fall into the trap. Because experience gives you knowledge, and knowledge feeds ego. But wisdom comes from remembering that the market doesn't owe you anything. Survival in trading is not about how smart you are, it's about how disciplined you remain. It's about how well you manage your emotions. It's about how consistently you respect your strategy. It's about how quickly you correct yourself when you feel your ego rising. It's about accepting that you're not in control of the market, only in control of yourself. Overconfidence destroys futures accounts. It destroys Forex accounts. It destroys crypto accounts. It destroys stock portfolios. It destroys confidence, energy, and psychology. And in every case, the pattern is the same. A trader wins big, becomes overconfident, takes reckless trades, ignores risk, and pays the price. The cycle repeats itself until the trader learns humility. The traders who make it long-term are not the traders with the biggest wins. They are the traders with the strongest discipline. They are the traders who can take a win and not let it inflate their ego. They are the traders who can take a loss and not let it destroy their confidence. They are the traders who remain emotionally balanced no matter the outcome. If you want to avoid blowing your account, you must take control of your mind. You must become aware of when confidence becomes arrogance. You must develop the ability to step back when you're feeling too certain. You must learn to question yourself in moments of excitement. Because trading is not about excitement, it is about execution. So let this be your reminder. Overconfidence will blow your account faster than fear ever will. Fear slows you down. Overconfidence accelerates destruction. Fear makes you think. Overconfidence makes you blind. Fear keeps you alive. Overconfidence knocks you out of the game completely. Stay humble. Stay disciplined. Stay patient. The market doesn't punish the cautious. It punishes the careless, and the most careless trader of all is the one who believes they can't lose. If you can master your ego, you can master your account. If you can master your mindset, you can master your results. But the moment you let overconfidence take control, the market will teach you a lesson you won't forget.